Hey guys, hope you and the families are well. In this video, I want to do two main things. Number one, I want to help you try and improve your trading. Number two, teach you about the psychology of playing to win. We're going to come at this from four main areas, which is encompassed by your mindset. So number one, how do you identify a high quality setup? Number two, how do you go about controlling risk to create asymmetric risk versus reward trading opportunities? Number three, how do you go about mitigating that risk? So free rolling the trades where you then can't lose money on the position. And number four, how do you go about optimizing the profits? I'm going to take you through three trades that I took from last week, which is Palo Alto, VRT, and also Uber. You're going to see a couple of MarketSmith charts as we go through. They're today's video sponsor. Discounted trial available in the comments below if you are interested. So let's just start here. A couple of trades from last week. The ones I'm going to highlight and show you on the slides, and we're going to look at it from my identify, control, mitigate, and optimize standpoint, is Palo Alto, Uber, and also VRT. A couple of other ones I took last week as well. Tesla in it, free rolled it, and then stop break even, and then Nvidia still in it with half the position, having free rolled that trade. But it's going to be Palo Alto, it's going to be Uber, and it's going to be VRT. So just to recap some of the key points from the blueprint video that went out, it's on the channel, that explains my trading process. So I'm looking for setups within these common chart patterns. So flags, triangles, pennants, cup of handles, wedges, flat bases, those are good things. And then I'm looking for specific things to happen, most notably the type of candlesticks and relation to where you see those candlesticks with the moving averages as well. So then there's some specific bars that I'm looking for. So trigger bars invariably are very tight candlesticks that occur on low relative volume and sit on one or more key moving averages. Now here's some of the data from Thomas Boswelski's book Encyclopedia of Candlestick Charts. Again, this is just recapping the recent blueprint video that has gone out. It's on the channel. If you haven't watched it, I highly recommend you watch that. And then there's type of shakeout demand tails as well. So I'm looking for entries around shakeout demand tails and gap down reversal bars, as you're about to learn as well. But I'm not necessarily trading those because sometimes the risk doesn't just make sense. So maybe I've seen a shakeout demand tail or a gap down reversal bar, and then I'm looking for a trigger bar to then form, which, as I said, is often an inside candlestick that occurs on low volume, sitting on one or more key moving averages. And you're going to learn about which moving averages in a couple of slides time. But you can see there's decent reversal rates on these, 60%, 66%. If I show you some iterations of gap down reverse bars, these are the type of bars I'm looking for. Now sometimes the risk makes sense on these bars, sometimes it doesn't, so I'll wait for a tighter bar where the risk makes sense. Don't worry, I'll explain all the risk in a couple of slides time. But it's piercing patterns, it's belt hold bullishes, it's meeting lines, it's thrusting patterns, it's bullish engulfing candlesticks. You can see the reversal rates, 64%, 71%. 56%, 57%, 63% with a bullish engulfing type of candlestick. And then these are kind of variations and setups I like to look for. So yes, I'm looking for those classic chart patterns. I'm looking for your VCPs, your flag, your Davis boxes, your wedges, your cup and handles, all of that good stuff. And then I'm looking for these type of candlesticks to occur. So it might be that I see a shakeout demand tail and then I see back-to-back inside bar. That could be a really nice setup. It may see that I see a gap down reversal bar and then another back-to-back inside bar. It might see that I see some form of shakeout demand tail, then an inside bar, or a gap down reverse bar, and then an inside bar. These inside bars really help to control the risk. So we're thinking about that second part of the trade, okay? We're thinking about how do we control the risk, create an asymmetric risk versus reward trade. But I do just want to emphasize this chart. This is a Dow Jones from nearly 100 years ago. Gap down reverse bars, shakeout demand tails, large operators accumulating positions. This is nothing new. This is timeless. So this is the weekly chart for the Dow Jones. Gap down reverse bars, shakeout demand tail, shakeout demand tail, shakeout demand tails, trigger bars, little kind of hammer type candlestick as well. It's nothing new. Give these even greater weight if they occur around the lows of developing bases and around one or more key moving averages. So let's go into a couple of the trades. So here we're going to start breaking down the thought process as well. So when I'm thinking about the trades, I'm going, okay, what are the type of setups for? Everything that I'm looking for then feeds into the screening. So I'm looking to identify those kind of setups every day as I head into the session. Now for me, when the US market is open, that's 2:30 p.m. to 9 p.m. because I'm in the UK. So I do my screening the night before. So my trading plan is created the night before. So I run through my screens. I look for a couple of thousand stocks usually, and I'm looking for these type of setups. I'm also looking for thematic things setting up. So at the minute, you may see that cybersecurity is very strong. Palo Alto, CrowdStrike, Zscaler, very strong stocks at this moment in time. And they kind of popped up, all three of those kind of popped up like this as well. But I targeted Palo Alto. So I can see here that it's a good reaction to the earnings. It comes down here and starts building this little low pivot in here, and it actually puts in back-to-back inside bars pretty much the bar in here that you see that I'm pointing to, it actually opens on the low of the bar and pushes up. I spoke about this in the blueprint video. There's an immediate presence of demand if the open for that candlestick is the low of the day. It opens, buyers step in immediately, and then it's this tight little inside bar which I call a trigger bar. Note how the volume is below the 30-bar average. Now, even more important, or just as important, is take a look how this relative strength line is turning up. So as this little handle, this lower pivot is forming here, and it's clustering around the 10, 21 and 50 SMA, the relative strength line is turning up. So even though the stock is basically just going sideways, okay, it's just horizontal, it's a little Davis box basically, a little rectangle, it's going sideways, but the relative strength line is turning up during this time. So that's telling me the market is under pressure, but this stock is just holding up well, and it's defiant in the face of a weak market. So if and when that market pressure is released, I'm expecting this to be that releasing of a basketball held underneath water. So it should pop back up with the bad sound effect as well. So this tight little inside bar, this is how I'm planning out the trade. So you can see I'm targeting it through the high. I use buy stop limit orders as I taught you in the blueprint. So targeting it through the high, this level here that you see 237.41 includes the slippage that I got as well, and then my stop loss is 1 cent below the low of the trigger bar, so my risk on the trade is 1.29%. Now relative to this stock's 20-day average daily range percentage of 2.48% is nearly half to 2/3 initial stop losses versus the ADR 20-day ADR percentage in my book is really good, certainly if it's sub 5% initial stop as well, and it's still half to 2/3 of 20-day. So I'm going in with tight risk control. Now let me show you this on the 1 hour chart, because you'll see I've said here, okay, entry is 237.41. So I'm buying it through the high of this trigger bar. Note the days. No, this is now on the 1 hour chart, and we're breaking down the trigger bar, looking at it on the 1 hour chart. So we've got 7 bars here. Subtlety, but you see the tightness in price here. It's basically a mini Davis box. And look how the volume is generally quite low as well. And then what I like is when I drill it down. So when I think I see a setup on the daily chart, again, it's one of those setups I've been teaching you, and then I drill it down onto the 1 hour chart. I like to see the 10, 21 and 50 period moving averages for that time frame in close convergence to each other, so they're not too far away. So it's just this textbook tightness in here. So I'm buying it through the high, stop loss underneath the low. Now you see here that the entry is at 237.41. okay, it's at this level here, this is where I'm buying it, and then I sold half of the position at 239.79. Now why on earth would I do that? Well, number one, I didn't know it was going to go up this high, did I? But again, that's all just in hindsight. So for me and my mentality is, okay, I want to hit this aggressively, and I want to take the risk out of the trade. So for me, this is a Sun Tzu Art of War principle, okay? Positioning myself beyond the possibility of defeat as soon as prudently possible. So what I do here is, as the stock starts moving out, I adjust my stop loss. So I move my stop loss from 234.34 up to the low of this now breakout bar by a single cent. So I'm moving my stop loss from 234.34 to 235.03. Now that brings down these free roll targets I taught you about in the blueprint. So now I can sell half of the position at this purple line, $230.79. That's my stutter kick in it. 239.79. That there is then my free roll target to take off half of the position. Now I'm effectively risk free on the trade. Of course, it can U-turn, it could gap down, I could have significant slippage, but hypothetically, I'm now risk free on the position within the first 1 hour candlestick, and I've still got half of my position there. So what I like to do is get in, hit it, and then give myself a free look on the trade as soon as prudently possible. So this is how I go about doing it. Now you see with Uber in a couple of slides time that actually I sold 1/3 of the position at 2 times the new stop loss placement. So you could do this off of the initial stop loss, or you could bump the stop loss up. But for me, when I see a stock breaking out like this and it's powerful, I'm going, well, it now shouldn't undercut the low that day. And if it's a choppy and hostile market environment, which it has been of late, I want to be quicker to mitigate the risk. So I'm playing aggressively to win, but I'm trying to get myself risk-free on the position very quickly. So I'm trying to get in, get it risk-free, and then go about optimizing the profits. So for me, what I'm then trying to do in terms of optimizing the profits is ride a combination of moving averages. Because in my head, the framework I have is a stock when it breaks out is it's going to pop, it's then going to test, and then it's going to reverse, and then that trend is going to kick in. So for me and my mentality when I'm playing to win and I'm trying to be aggressive is I want to free roll it into the pop, sit through the testing action, then play the stock for a bigger move and let a big trend play out. So this is now how the trade is set up, and I've now got my stop loss above my entry price on the remaining half of the position at 238.93, and I'm expecting a testing action probably into the 10-day EMA 250 level, but I'm trying to sit through a test and then play the stock for a much bigger move, because Palo Alto, as with some of its brother sister cybersecurity stocks being Zscaler, the CrowdStrikes of the world, have built some significant bases. So law of cause and effect, bigger causes tend to lead to larger effects. So this is how it has been playing out. And here are some of the fundamentals that you can see. So Palo Alto, I bring in the fundamentals as well. So what you can see here in terms of the cybersecurity related stocks, this is one of the CanSlim leaders. Certainly when you think about it from an institutional quality standpoint, good market cap, 80 billion, computer software security, strong group, 23 out of 197. You can see that big old boys Fidelity are in there, initiated a position in Q1 2023, added in Q2, added in Q3, like that. EPS just going up year over year into all-time high territory. Institutions absolutely love that. You can see the growth here in terms of the EPS as well. So look at the quarterly acceleration from 55 cents to $1.44, and you can see the sales growth as well, going from 1.2 billion to 1.9 billion. Generally speaking, you've got quarter over quarter and year over year sequential growth. Institutions love that stuff. VRT, so I'm going to just show you this on the weekly charts. My entry is coming through here, but on the weekly chart, for me, this is textbook. I'm like, whoa, there's a load of demand coming through on this week here. Look at the 52-week high on the relative strength line. There's a load of demand coming through on this week here, coincides with the earnings, 52-week high, and then look how orderly the pullback is into its 10-week, being the black line in here. Really like it from a weekly standpoint. And then I'm dialing in and I'm looking at the chart and going, okay, they raised full year guidance from the range of $1.22 to $1.34 to $1.54 to $1.64, and there was an EPS surprise of 59% as well. This stock is involved in thermal management, which I think is going to be a fairly big area as well. On the earnings gap up, where there was that surprise and they raised full year guidance, second largest volume ever on the stock, and it coincides with a 52-week high. Look at all the relative strength 52-week high to 52-week highs. I put a significant emphasis on that. So for me, the stock is building a sizable base, back-to-back inside bars, and it's just sitting there on its 1021 EMA. So a clustering of those key moving averages. So inside bar, back-to-back inside bar, volume below the 30-bar average, and it's hitting a 52-week high. One of the strongest signs the strengths a stock can possibly give, in my view, is a 52-week high, and it's still in the base, and it's gone back-to-back inside bars, sitting on one or more key moving averages. Strong stock. So let me show you this trade here, okay? So on this one here, again, I took a half off quite quickly. Why? Because I think we're in a choppy and hostile market environment. So if we're in a choppy and hostile market environment, that third part of the trade, I'm speeding it up. I'm speeding up that process to free roll the trade, get the risk out of the trade quicker. So I'm not holding on for bigger moves and potentially selling less of my position. Okay, so instead of selling maybe a third or a quarter of the position, I'm actually looking to more aggressively sell off half of the position into a pop, adjust the stop loss up, be risk free on the trade, and then see if it wants to trend. But in a better market environment, I'll be a bit slower to do that. I'll wait for bigger levels, but certainly from a controlling standpoint as well, I want everything to be nice and tight. Tighten everything up. Be quicker to free roll in choppy hostile market environments. That's what I do. So VRT here, okay, my entry here is 38.62, so I'm buying it here. This was the trigger bar, this was the second of the inside day, so tightness in price here. I quite like it when the close is really close to the high of the day as well. I use the marathon runner analogy fairly often in terms of thinking about how much energy the stock has to use just to make it to the price where I am looking to enter. So I like stocks to close really close to the high of the session ideally. Now the first 1 hour candlestick is actually a gap down reversal bar, okay? Prior closes here, gaps down here, a little shakeout demand tail on it, then it starts powering through. Now what I like is I don't like stocks that gap above the highs of trigger bars or gap down reverse bars or shakeout demand tails, because from a trade management standpoint, it just makes it so much harder as well. So what I actually like is for the stock to open where it opened. It's fine to open there. It's fine if it opened a little bit higher. It gives me a really logical place to adjust my stop loss to if and when the stock starts breaking out. So what I do here is I just adjust my stop loss from 37.29 and then I just push it up cent below the low of the now breakout day of 37.52. So I push the stop loss up, brings down the free roll targets. So now I can take a half off here at 39.73. And then that means I free rolled the trade. Yes, it can gap down. You can have slippage and stuff like that. But now I've got half of my position, and in the first 2 hours of the trade, I'm risk free on half of the position. That's where I want to be. Certainly in more difficult market environments, I want to be risk free as soon as I prudently can. So this is the advantage for me of targeting these nice tight bars, because my expectation is they should break out, they should push. If I've got my stop loss tight relative to the ADR percentage, so 3.44% relative to the ADR of about 4.5%, it's around about 2/3. So my expectation is, well, price can go up because it's done it over the last 20 days on average. It's moved 4.5%. So it's reasonable to expect it could get out 4.5%, and I can then free roll into that pop. So I'm trying to get myself risk free on the trade, very, very quickly. It should move quickly through this level. VRT fundamentals, I think, are solid. Okay, it's into all-time high territory, is relatively new. It was a SPAC over here, builds this big sizable base in here, powerful uptrend, 99 RS, some high quality funds in there. Look at the earnings coming through as well. So in the most recently reported quarter, the quarterly earnings are 46 cents. Now that is nearly double anything that's been reported previously. The highest previously was 28 cents. So it's really standing out. Sales growth as well, 1.2 billion up to 1.7 billion. Estimates for this year, 204%, with the guidance up going into all-time high territory. So this company has gone from basically losing money to 76 cents, 53 cents, $1.61, and then the estimates for next year, $2. That is standing out like a sore thumb, and some of its brother sister stocks at the time were very strong as well. Let me show you Uber. So this is one that I got knocked at break even. So there were a fair few of the TML type stocks putting in inside bars around this time. The Nvidias of the world, the Teslas of the world as well. So Uber, it's kind of like a low pivot. It's maybe not the best one, but I was looking around the lows, and I'm like down here, I'm like, gap down reverse bar, shake out demand tail, shake out demand tail, tighten outside bar, gap down reverse bar, gap down reverse bar, gap down reverse bar. Then I'm looking at the prior candlesticks to my entry, which is here, this inside bar, shake out demand tail, gap down reversal bar, and there wasn't that much volume on those two bars. See, it's just the average. That's just telling me there's not that much selling pressure here. So I'm like, well, Uber, I think it's going to power through the 10, 21 and 50. I think it's going to reclaim those. I was expecting it to stall into these base highs in here, so I'm like, okay, I could target it there. If it starts moving out, that's great. I can then free roll it into that, sit for a testing action, see if Uber then wants to come out of a sizable base. So I'll take you through on the 1 hour chart so you can dial it in and see it a little bit more, okay? So we'll dial in. So this is the final session. Okay, this is that inside bar broken down onto the 1 hour chart. So my entry is here at 45.79. So this here is my entry. Now Uber starts powering out, and I'm like, this ain't just retail traders doing it. This is large operators. And again, I'm still on hostile choppy market environment. I'm on choppy at the minute, but there has been a couple of hostile days. So I'm like, I'm ebbing and flowing between them mentally. So when I'm like that and I think, okay, it's a difficult market environment, I want to be quicker. I want to get the risk out of positions. So my entry is here at 45.79. Okay, I sell 1/3 of the position this time at 46.28. Now why was I able to do that? Well, Uber's just powered out here. So what I can do is I can adjust my initial stop loss of 2.66%, which is tight relative to the ADR, which is about 3.2%. Okay, so this stop loss here, okay, is about 2/3 versus the ADR of 3.2%. So 2.66 is about 2/3. I'm no mathematician, but is about 2/3 of 3.2. Okay, so remember, half to 2/3 is ideal. So what I can then do is push my stop loss up from 44.57. I can push it up to the low of this breakout day, because my expectation and reason for buying it, well, it should be breaking out. So if it U-turns after a bar like this when it's breaking out powerfully, I probably don't want to own it. Uber should just rip higher here, and I should be able to free roll into it. It shouldn't now undercut this low, really. It just, for me, everything would basically look wrong. And you can see it really starts looking wrong over here when it does, and I get knocked out, effectively break even, had a very, very marginal loss on the on the position. I think I had like, yeah, it was like maybe a couple cent slippage or something like that from memory, marginal loss, but effectively break even on the trade rather than a full stop loss, which I'll talk about. But because of the strength of how Uber powers out here, and because of where the lower the candlestick is, well, that then dictates about where are my free roll levels. So I can adjust my stop loss up from down here at 44.57. I can move it up here underneath the low of the now breakout candlestick by a cent, and now my free roll targets, well, 1/2 is 46.04, and I use the fib retracement tool and set these to these levels. There's videos on my website on the platform about how I go about doing this and setting my charts up and using the fib retracement tool in this manner. Or I can take 1/3 of the position off at 46.29, because that's now 2 times my new stop loss. I don't give a damn where my initial stop loss is. Now maybe I could free roll off of my initial stop loss level, but if a prudent opportunity presents, I'm going to use that opportunity, certainly in more difficult market environments. So I don't care where my initial stop loss is, and well, I'm only going to free roll when I hit 2/3 or I hit double, or I hit 2 times my initial. I don't care. I do not care. My objective is work through the phases. Number 1, identify a high quality setup. Number 2, control the risk. Number 3, mitigate the risk. Mitigate the risk. Get the risk out of the position. Then number 4, once I've mitigated the risk, once I have free rolled the position, then I'll think about optimizing the profits. So with Uber here, it's potentially coming out of a really big base. I free rolled it in the first hour, so now hypothetically I've got 0% risk on the trade, and I got 2/3 of my position. Go gadget, go Uber. See if you want to break out of this big base. If you don't, that's absolutely fine. I'll get knocked out, break even on the trade. So then I get knocked out, break even over here on this bar here, and this is why I then did it. Because if it starts undercutting the low of this bar, I don't want to own the stock. Something is wrong with it. It's not acting how I expected it to act. I don't want to be in the position anymore. So you're going to have a lot of losing trades. It's going to happen. You are not going to be right. anywhere near 100% of the time. And risk mitigation, what I'm trying to do is those losing trades where I could have had a 2.5% loss, or a 4% loss, or a 5% loss, or a 1% loss, 1.5%, 3.5%, whatever it may be, on those losing trades, actually can I mitigate those losing trades in terms of bringing down how much I lost on those trades? So instead of coming out the other side, imagine if I could do this over the course of 1,000 trades. Imagine if I had 1,000 losing trades, and I've already had 1,000 losing trades, I'm going to have 1,000 more, but imagine if I can bring the loss down on those losing trades I'm going to have. So instead of it being 2.5% or a full stop, wherever that may be, actually I can get out around about break even. That's what I'm trying to accomplish by the risk mitigation. So risk mitigation is not to maximize the upside, it's to minimize the downside. Really, really important. Minimize the downside. I put such a significant emphasis on this. Now, Uber, I think it's pretty interesting. JP Morgan so far this year have invested hundreds of millions of dollars in the stock. You can see 24.5 million shares they nearly own at the time of previously reporting. Uber actually reported earnings coming through in the most recently reported quarter, 8 quarters growth in terms of sales, 4.8 billion up to 9.2 billion, and the estimates going into all-time high territory. Really, really look like that. So maybe Uber sets back up, maybe it doesn't set back up, but for right now, stop out of it. Maybe it'll shake back up, or maybe there'll be some other stocks to target. And yeah, exciting times ahead. So anyway, guys, I hope that video there has helped explain how I think about trading. Really wanted to dive deep in terms of some of the psychology, playing to win, working through the process of identify, control, mitigate, and optimize. I think it's really, really key. Hopefully you like the recent blueprint video that will take you through all of those areas in depth. So thank you for watching. Thank you for supporting the channel, and I look forward to seeing you in a future video.